Another housing crash is starting, and this time it's worse than 2008. In 2009, in the staggering aftermath of the global financial crisis, the world of finance drastically changed, and the Fed made unprecedented policy changes. History is repeating itself. The U.S. housing market is going through a crucial period in 2023 with alarming opinions on the future of the economy. Although it has been experiencing a period of significant growth in recent years, with record low mortgage rates and high demand pushing home prices to all-time highs, concerns about a housing market crash have started to surface, with experts sounding the alarm that we're on the verge of a crash. Currently, experts say that the combination of high mortgage rates, inflated home values, and lower buyer demand will pave the way for the challenging year ahead. The impact of rising interest rates is the most critical concern. This has led to stagnation, and homeowners with existing mortgages at lower interest rates are reluctant to sell their properties because purchasing a new home would mean taking on a mortgage with significantly higher interest rates. The average rate on 30-year mortgages dipped to 7.41%. That's near the highest level since December of 2000. The increase reflects not only the Federal Reserve's continuing fight against inflation, but rising Treasury yields and the imminent threat of a recession. The central bank raised rates a quarter point in July, its 11th increase since 2022, and it will consider another rate hike at its September 20th meeting. While the Fed doesn't directly set fixed mortgage rates, it does establish the overall tone. Many borrowers have been spooked by the recent rise in rates. The Mortgage Bankers Association reported this week mortgage applications fell to their lowest level since 1996. Inflation, the economy, and Fed policy will remain the main factors driving mortgage rates in the coming months. The latest inflation numbers, released September 13th, suggested prices are rising again. Experts are now warning that wage pressures, combined with higher gas prices, are an even bigger problem in the last quarter of the year. And with the Fed continuing to fight inflation, historically, mortgage rates tend to follow the Fed's behavior. This is exactly why their actions have a direct influence on mortgages, because interest rate movements affect borrowing costs. This directly impacts mortgage rates, which we're now seeing investors, hedge funds, house flippers, and large investment banks reduce their purchases in the housing market. Investors now view home buying as less profitable compared to the housing boom in the past few years, further contributing to current market sentiment. Commercial property prices are also plummeting, posing risk to banks with significant exposure to real estate loans. If home sales continue to decline due to rising interest rates, it can have a cascading effect on many of our industries. A downturn in real estate can lead to reduced demand for goods and services related to housing, which in turn affects industries like furniture, landscaping, appliances, and more. Charlie Munger has warned of a brewing storm in the U.S. commercial property market, with American banks full of what he said were bad loans as property prices fall. The comments from the 99-year-old investor and sidekick to billionaire Warren Buffett come as turmoil ripples through the country's financial system, reckoning with a looming commercial property crash following a handful of bank failures. This reduction in property values will significantly impact property owners, investors, and financial institutions. Major U.S. banks are exposed to commercial real estate loans and investments, with a substantial portion of their deposits and holdings tied to this sector. Total bank exposure to commercial real estate is approximately $3.6 trillion, which accounts for about 20% of their deposit holdings. A significant portion of this exposure consists of commercial mortgage-backed securities and loans to non-bank lenders, totaling approximately $623 billion at the end of 2022. This exposure puts banks at risk if property values continue to decline, and due to the drop in property prices, lenders are facing losses on their loans, which can have a cascading effect on financial institutions. In the past decade, regional banks increased their commercial loans, but they are now dealing with unexpected challenges as property values decrease. The risk of losses has led banks to reduce their new commercial loans. This reduction in lending activity has declined by 52% for the second quarter year over year, and lending volume among banks has dropped by 48%. Some banks, such as M&T, have announced plans to reduce their commercial lending activities due to concerns about the health of loans to office landlords, many of which are facing difficulties. Chairman Jerome Powell has warned of the need for further interest rate increases to address inflation concerns. He emphasized that despite a slight decrease from its peak, inflation remains at a level that the Federal Reserve deems too high. As a result, the central bank is committed to taking action to bring inflation in line with its 2% target. Chairman Powell's warning implies that the Federal Reserve is prepared to continue its current policy trajectory, which involves even more rate hikes. The central bank intends to hold policy rates at a restrictive level until they are confident that inflation is moving sustainably toward their objective. As interest rates rise, borrowing becomes more expensive and less accessible for these enterprises and will significantly hinder their ability to secure loans for operational needs, expansion, or investment. How could the turbulent events of the past few years, with ridiculously high inflation and a slowing economy, lead to a housing market that holds its value? This brings a significant and concerning threat of foreclosures and evictions that looms overhead due to the challenges in the housing market. Rising interest rates have made it increasingly difficult for homeowners to meet their mortgage payments. Many homeowners, especially those with adjustable rate mortgages or those seeking to refinance, face higher monthly mortgage obligations. If the economic conditions persist and more homeowners struggle to make their payments, these mortgages will be underwater. This means that the outstanding loan balances may exceed the current value of the homes. When homeowners default on their mortgages, lenders may initiate foreclosure proceedings to reclaim the property. This also puts renters in a vulnerable position. A surge in foreclosures and evictions will have a major impact on the housing market and will lead to an oversupply of homes, putting further downward pressure on property values. Shark Tank investor Kevin O'Leary revealed the cold, hard truth on America's housing market, warning that September will be the start of real chaos for the U.S. economy. Kevin said, "These rapid rate hikes that have occurred, unprecedented speed of these hikes, have put my small business in crisis. And I'm talking about companies with 5 to 500 employees, which represent over 60% of our economy. If you're in the S&P 500, you have no trouble financing your business. You can't say that about small businesses anymore. The cost of capital has gone through the roof." Michael Burry's firm, Scion Asset Management, has put $1.6 billion on a Wall Street crash by the end of this year. Burry's fund is also getting out of its shares in a number of regional banks, It sold its 150,000 shares of First Republic Bank, as well as holdings in Huntington Bank, PacWest, and Western Alliance. He gained global acclaim as one of the first investors to predict and profit from the subprime mortgage crisis that occurred between 2007 and 2010. And to show he is dead serious on another U.S. meltdown, Burry is using over 90% of his fund's portfolio to bet against what many still believe to be a safe economy. The scarcity of available homes for sale has led to increased competition among buyers as well. In July of 2023, the number of listed homes was just over half of what it was in the same month of 2019. Additionally, 29% fewer new listings entered the market in July compared to the pre-pandemic norm. This scarcity has resulted in homes under contract going pending in a mere 12 days, a notable difference from the 2018 and 2019 averages. The combination of tight inventory conditions and elevated mortgage rates is expected to continue influencing sales volume in the foreseeable future. Zillow's projection for 2023 foresees 4.2 million home sales, reflecting a 17% decline from the previous year. Forecasts of U.S. home prices are up, with the typical home value predicted to rise 6.5% from July 2023 through July 2024. Tight inventory conditions continue to place upward pressure on prices. Economic experts are once again sounding alarm bells over an imminent downturn. A U.S. recession is coming, they say, in the last part of 2023. The importance of preparedness in the face of this coming crisis is critical. Financial planning and emergency savings are absolutely necessary to weather this economic storm. Recently, billionaire investor Stan Druckenmiller didn't mince his words this week at the Sohn Investment Conference, saying, "A hard landing is coming. It's just naive not to be open-minded to something really, really bad happening." For more than a year, CEOs, economists, and analysts have been warning of an imminent economic downturn. We're also seeing more bank failures, making borrowing significantly harder, which will curb spending and weigh on economic activity. A recent Fed survey released Monday confirmed that lenders are stiffening their standards in the wake of banking collapses, with demand for and supply of loans now being close to 2008 levels. Analysts expect the world's major economies, including the United States and the United Kingdom, as well as the Eurozone, to slip into a recession this year as central banks continue raising interest rates to temper demand for consumer goods and services in an effort to rein in raging inflation. Comment down below on what you think, and leave a like if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.